So is actively trading options better than passive investments? You buy and hold shares of SPY or QQQ, right? Is options trading better than buy and hold? Well, if you ask me, I'm going to say absolutely. But here's the caveat. It's for me and people that trade like me. It's for people that want to be actively engaged in the market. They want to actively manage their portfolio. They want to strategically maneuver, right? They want to hedge when hedging is necessary. They want to take additional risk when there's opportunity in the market. They want to take off risk when there's not as much opportunity in the market. They want to be actively in there, duking it out and trying to make every dollar they can. For people like that, yes, options trading is far superior than buy and hold investments. But not everybody is like that, right? No, some people just want to go and load up on shares of SPY or QQQ and just sit on it for the next 20, 30, 40 years. And when they come back, they're going to turn, a few $100,000 into $1 bajillion. Legitimately, that's a viable strategy. But can I do better actively trading options than just sitting on shares of SPY? I think I can, partly because options has a little bit more leverage. It has the potential for higher returns, especially over shorter time frames. I have also the more potential where I can put on many, many more trades sometimes using the buying power of an option strategy. For example, if I sell a put, there's nothing saying I can't also sell a call against that put for basically no additional buying power, because I'm already using buying power selling the put. I can't lose on both a short put and a short call. So a lot of times with options, you get to double dip on trades. I get 2 trades for the price of 1. Now, where buy and hold really outshines actively trading options, for example, is if you want to have a really low maintenance kind of wealth accumulation, right? You just want to sink all your money into a market ETF and then never check on it, right? Just come back 20, 30, 40 years and whatever happened. And for many people, that's what they need, because they really are not interested in learning how to trade. Maybe they don't have time. They work a 9-to-5 job. They can't be in front of a computer during regular stock market hours. There's certainly nothing wrong with those that choose to go the buy and hold passive investment route. But if you're somebody that does follow the market and you're actively involved with your portfolio anyway, just sitting on shares of SPY or QQQ or any other kind of market ETF, I think you could do a little better. So a couple of weeks ago, I made a video where I was showing a strategy for QQQ. I was showing a put credit spread strategy in QQQ. Let's actually put on this back test. So let's do a credit put spread. That's your standard put credit spread. And the one I often do is a 60 DTE strategy. Let's do this. Let's sell the 35 delta put, and then let's do a dollar amount. So let's hit the chain here and let's buy 1 contract at $10 below. And then we're going to not use a stop loss. We're going to take a profit at 50%, and we're going to exit at 21 DTE if we don't hit 50%. We put it on at 60 DTE. If we hit 50% before 21 DTE, it comes off as a winner. If we don't hit 50% winner before 21 DTE, at 21 DTE, it's coming off regardless. And then we're going to do this every week on Friday, and we're going to back test it for the last 5 years in the Qs. Let's run the back test. And the back test is going to take a few minutes. There's a lot of trades every week for the last 5 years. Now, every time I do one of these back tests, people often focus on these numbers down here, and I always warn them, be careful looking at these numbers. So you have the strategy that we're employing, and we get total profit and loss, our max drawdown, return on capital used, and then buy and hold. What if we just spent the same capital that we used on with our option strategy? What if we just started with that capital, sunk it into QQQ, and held it for the last 5 years? And you can see the percentages right now on these strategies. This put credit spread strategy I'm using barely outperforms just buying and holding QQQ. Well, you have to understand something, that options are not like buy and hold. I'm probably not just putting on these put credit spreads every week in the Qs and never ever trading anything else around it, right? I have, if I go to my positions, I have a lot of options positions on right now. And I'm really light actually right now in the market. I'm only using 30% of my buying power. I'm really light. Most of the time I have maybe twice as many positions on. So, this is very different than the buy and hold mentality, where buy and hold mentality is you buy stock or ETFs, maybe a handful of market ETFs, and then you just sit on it forever. And you're always permanently long the market. If the market crashes 30%, that month for whatever reason, the market occasionally does crash, well, you take a 30% drawdown in your account because that's all you can do, because you're just long the market. You never short the market. You never hedge in any way. Typically, as a passive investor, that's not what you're doing with options. So you can't treat these numbers the same, right? The buy and hold numbers are the buy and hold numbers, but don't think that this is all I'm doing in my portfolio if I employ this 60 DTE put credit spread strategy in the Qs. First of all, when I sell a put credit spread in the Qs, if I wanted to sell a call credit spread on occasion, I wouldn't do this over and over again, because a call credit spread is going to be a losing strategy in the long run, because it's a bearish strategy and the Qs tends to go up, right? The NASDAQ 100 tends to have a positive drift. So I wouldn't just sell call credit spreads all the damn time, but occasionally I might sell a call credit spread in turbulent market times like 2022, which was mostly a down year. To hedge my bets on the put credit spreads I'm doing, I might sell call credit spreads, or I might just stop doing put credit spreads altogether and just do call credit spreads, right? I can do that as an active trader, right? But for back testing, you can't really back test like that. You can't back test like an active trader. The back test is just a machine. It's almost like buy and hold, right? Where it's treating my put credit spread strategy as a forever buy and hold kind of position. I'm just putting on the same position every week, and whatever happens, happens. And that's how you have to do it to test it. But in practice, that's not the way you're going to trade this thing. Also, when I'm doing all these back tests, whether I'm doing, short puts, long calls, whatever it happens to be, and I'm getting the percentage of return on capital on these option strategies, sometimes they greatly underperform the buy and hold. Sometimes they greatly outperform the buy and hold strategy. But again, don't take these as gospel, because in real world practice, the strategies like this strategy that maybe you think is not that great and it's very similar, maybe it underperforms slightly, especially when you take fees into account, you're taking all those trades, you're paying taxes. Keep in mind, this is not the only thing I'm doing while I'm doing this strategy. There's other trades that I can potentially put on for no additional buying power even. So, or the ones that greatly outperform buy and hold, don't take those as gospel either, because I could easily do a new back test. Let's do it. Let's do a buy a call strategy. This is not a strategy I would typically do, but let's buy a 50 delta call, so an at the money call, every 8 DTE on Friday, and we'll take it off at 1 DTE. We won't hold it to expiration. And then we're not going to take 50% max profit either. We're going to let this run because this has unlimited profit potential, right? A long call. Now, this back test is probably going to be really good. I don't know. We'll check it out here, but I'm imagining that it's going to probably greatly outperform buy and hold, especially in a bull market. You can see 2022 was nasty. We lost 100% of our account, but let's ignore that for now, because we're about to get into the bull market, and this thing is just going to take off, right? And there you go. We're already way at a buy and hold now, and it's just going to get even better here in a minute. So there you have it. 152% return on capital versus 106% return on capital. But again, that's not the whole story, is it? The whole story is, well, we blew up our account on January 6th of 2023 because we lost 100% of our money, right? So again, don't focus too much on return on capital on these back tests, because they don't tell the whole story. The other story they don't tell is leverage. They don't tell you, like the Qs, if in a regular Reg T margin account, this is probably how they're factoring the capital used. But if you want greater leverage trading options, you would not trade SPY or QQQ. You would go to the futures. You would go to the ES futures if you wanted to trade the S&P 500. You would go to the NQ futures if you wanted to trade the NASDAQ 100. Why? It's because you get much greater buying power relief. You get like 4, 5, sometimes 6 to 1 margin on that, which greatly increases your return on capital. So a lot of times, when I'm backtesting SPY, I'm going to trade the ES. And a lot of times when I'm backtesting the Qs, I'm going to trade the NQ, right? And again, that return on capital will be way higher on those products. So again, just take this for what it's worth. And you're probably wondering, hey, well, why don't you just backtest the ES futures and the NQ futures? You can't. And the reason you can't is because futures products are not like a stock or an ETF. They don't have a continuous kind of contract, right? ES, you can see right now, if I go to ES, it is ES Z. Z is the quarter, the contract we're in. That is Z25. If I go to the options chain here, you can actually see every quarter we're on a different contract. Right now we're trading this contract, which is trading at 67.80. If I go 3 months out to the next quarterly contract, it's trading at 68.40, and it's trading, right? So you've got different futures contracts for the ES, right? And because of that, you can't really backtest the ES because every quarter is a different contract with different pricing and they don't match up. So I can't backtest the ES. I can backtest SPY though, and you theoretically, backtesting SPY should give you the results for basically what ES would do. Same thing with NQ, the NASDAQ futures. I just backtest QQQ. But you have to keep into account that, yeah, you're going to get much greater return on capital if you're primarily trading futures options rather than stock/ETF options. And then finally, also understand that an options portfolio probably is going to look something like this, right? You're going to have a lot of positions and a lot of different underlying, some bearish positions, some bullish positions, some neutral positions. I got a lot going on. Some positions and products that are highly correlated. Some products are inversely correlated to each other. I got a lot of stuff going on in this portfolio. And why is that? It's because that's what you want as an options trader with buy and hold. If I just buy and hold shares of QQQ, stock chart has a gradual drift up, but it zigs and zags wildly on the way up. You see massive swings in your P&L. But with options positions, especially what I primarily do, sell puts, sell options. So if I sell puts in the ES, I'm going to have that gradual drift up, but I'm not going to be zigging and zagging nearly as much as the person that's just long shares of stock. And then because I also will occasionally do some other stuff other than sell puts, maybe sell some calls along the way to hedge the puts a little bit, maybe trade other correlated products where my portfolio P&L will be a very smooth line. You know, maybe it doesn't go up as much as buy and hold. Here's another thing to consider. Maybe my options portfolio does underperform buy and hold, but it's a very smooth line that never has me worried, that I never wake up one day and I'm down 25, 30, 35% of my account, right? I don't have to worry about that if I'm trading options in a responsible way, and especially actively trading, you know, with having dozens of positions on and basically treating the whole thing as one big position. So that is the difference between actively trading options and passive buy and hold investments. And one final thing to consider, if you're somebody that's just starting to trade and you don't have a lot of money, options is great because of the leverage. You can actually put on some trades for, you know, $100, $200 that have the potential for you to make a couple of $100, right? This is not something you can really do with buy and hold investments. You can't go buy and hold some shares of a stock or ETF for just $100 or $200 and have the potential to make $100 or $200 because you would need to buy a really cheap stock and have that stock double in price. That's never going to happen, right? That's a matter of fact, the really cheap stocks are the ones much more likely to go bankrupt than actually go up in price. If you're somebody starting with a small amount of money, say just a few $1,000s, buy and hold is not going to do anything for you. Let's say you start with $10,000. You start with 10 grand and you sink it into SPY, and you know SPY tends to go up about 10% every year. And let's say that SPY goes up 10% next year, as you would expect, right? You just turn your 10 grand into 11 grand. Congratulations. What did that do for you? Really, right? But how about actively trading that 10 grand with hundreds of options positions that whole year? What is your potential? Well, it would not be unusual to turn that 10 grand into 12 grand or 14 grand or even 15 grand. That's not a crazy thing. That does happen. I've had years where I've had 50, 60, 70% returns in a year. It's very unusual. A lot of things have to go your direction, right? You got to get a little lucky, but sometimes you get that, right? And you're not really going to get that with buy and hold. Buy and hold, all you do is whatever the market returns, that's what you get, and that's all you get. Now, if you want to learn a little more about options trading, and especially my favorite option strategy, which is the wheel option strategy, check out my book, The Super Wheel Option Strategy. This book, it's available on Amazon. You'll find a link to the book in the description below. Peace, guys.